What's up, everybody? Today, we're diving into the world of S corporations. We'll explore the audit traps that could potentially cost you thousands of dollars. With the IRS ramping up its enforcement efforts, S Corp are increasingly under the microscope, especially because of the significant tax advantages they offer. I'll break down the top 3 critical mistakes S Corp owners often make that can trigger audits. This includes how you classify your workers, how you pay yourself properly, and how you handle company money with care. By the end of this video, you'll know exactly how to keep your S Corp compliant and safely off the IRS radar. Let's get right into it. Let's dive into some common pitfalls that can trigger an audit for your S Corp. First up, misclassifying employees as independent contractors. This is a really common mistake, and it can have serious repercussions. Many business owners, in an attempt to streamline operations and reduce costs, inadvertently misclassify their workers. This is a classic audit trigger. The IRS is always on the lookout for this type of misclassification because it directly impacts tax revenue. They see it as a potential area of abuse, and they're very diligent in investigating these situations. It's tempting to call someone a contractor to save on payroll taxes and paperwork, and we understand the appeal. The immediate savings can seem significant, especially for a small business just starting out. You avoid things like Social Security, Medicare, and unemployment taxes. But the IRS has strict rules. These rules are in place to protect workers and ensure fair tax collection. They're not arbitrary. They're based on a long history of legal precedent and economic considerations. They look at 3 things, and these 3 things are crucial in determining whether someone is truly an independent contractor or should be classified as an employee. Understanding these factors is key to staying compliant. Behavioral control. This refers to the extent to which the company controls what the worker does and how they do it. Financial control. This looks at who controls the financial aspects of the job, such as how the worker is paid, whether expenses are reimbursed, and who provides the tools and supplies, and the relationship of the parties. This examines how the worker and the company perceive their relationship. Is it intended to be ongoing, or is it project-based? Are benefits provided? If you control how, when, and where someone works, dictating their hours, location, and methods, they're probably an employee. The more control you exert, the stronger the case for employee status becomes. Contractors set their own schedules, managing their time and workload independently, use their own tools, investing in their own equipment and software to perform their services, and are paid for results, not hours. They're focused on delivering specific outcomes, not just putting in time. Financially, contractors have their own expenses and can profit or lose, bearing the financial risks and rewards of their business. If you're their only client, and they don't have other clients they're actively serving, and you pay all their costs, covering their expenses and providing them with resources, that's a red flag. It strongly suggests an employer-employee relationship. Benefits like paid time off or health insurance? That's employee territory. Contractors typically don't receive these types of benefits from their clients. If someone's been with you for years, consistently working for your company, working full-time in a core role, performing essential functions within your organization, the IRS will see them as an employee, no matter what the contract says. The substance of the relationship outweighs the form. Get this wrong. Misclassifying an employee as a contractor. And you'll owe back payroll taxes, penalties, and interest. These costs can quickly add up and become a significant financial burden. It can devastate a small business. The financial strain can be overwhelming, potentially leading to closure. So be honest, is this person truly independent? Are they operating as a separate business entity? Use the IRS guidelines as your checklist. Review the factors carefully and assess your relationship with the worker objectively. If you're unsure, file Form SS-8 with the IRS for an official determination. This is a proactive step that can provide clarity and protect you from potential penalties. Always have a clear, well-drafted contractor agreement, outlining the scope of work, payment terms, and the independent nature of the relationship. But remember, actions matter more than paperwork. The actual working relationship must align with the terms of the agreement. Don't give contractors company emails, as this can blur the lines between contractor and employee handbooks, or staff event invitations. These are typically reserved for employees and can suggest an employer-employee relationship. The IRS is cracking down, increasing their scrutiny of independent contractor classifications, especially on businesses, issuing lots of 1099-S to the same people year after year. This pattern raises red flags and increases the likelihood of an audit. The cost of payroll taxes is nothing compared to an audit. The potential financial repercussions of an audit far outweigh the perceived savings of misclassification. Protect your S Corp. Classify workers correctly from the start. It's a fundamental aspect of responsible business management. If it looks and acts like an employee, pay the payroll taxes and move on. Don't try to cut corners. It's not worth the risk. Don't risk your business over short-term savings. Focus on building a sustainable and compliant business for the long haul. Next, let's talk about reasonable compensation. This is a critical area for S Corp owners, and it's one that often gets overlooked or misunderstood. Getting it wrong can lead to significant problems with the IRS, so it's essential to understand the rules and how to apply them to your specific situation. Reasonable compensation is the #1 S Corp audit trigger. It's the issue that IRS auditors focus on most frequently when examining S Corp tax returns. S Corp offer a unique tax advantage. They let you split your income between salary, which is subject to Social Security and Medicare taxes, taxed for Social Security Medicare, a combined rate of around 15.3%, and distributions which are not subject to these taxes. This is where the potential for abuse comes in, and why the IRS pays such close attention. But the IRS demands you pay yourself a reasonable salary first. This is the cornerstone of S Corp compliance. They want to ensure that you're not avoiding payroll taxes by taking an unreasonably low salary and excessive distributions. You can't just pay yourself $12,000 thinking you're saving on taxes, and then take $200,000 in distributions. That's a red flag for the IRS. The IRS will reclassify those distributions as wages, meaning they'll treat them as if you had paid yourself a higher salary all along, and hit you with back taxes, penalties, and interest. This can be a very costly mistake. So what's reasonable? That's the million-dollar question, isn't it? It's generally defined as what you'd pay someone else to do your job if you were to hire an employee to fill your shoes. This determination is based on several factors, including your specific duties, your level of experience, the industry you're in, and the geographic location of your business. The IRS will check market data from various sources, scrutinize your actual role within the company, and even consider the number of hours you work. If you're not just the CEO, but also handling sales, marketing, and even cleaning the office, the janitorial duties, your salary should reflect the value of all those combined roles. Don't undervalue your contributions. Don't use arbitrary splits like 60/40 inches between salary and distributions. That's a shortcut that often leads to trouble. The IRS doesn't care about your preferred split. They want to see real-world justification for the salary you're taking, based on market data and your actual responsibilities. If your company is consistently profitable and can afford to pay out distributions to its shareholders, it can likely afford to pay you a fair and reasonable salary as well. The IRS will certainly look at the company's profitability when assessing your compensation. To protect yourself from potential IRS scrutiny, it's crucial to thoroughly document your salary decision-making process. Utilize online resources like Salary.com or Glassdoor to research comparable salaries for similar roles in your industry and location. Print out the relevant data you find and keep it in your business records as evidence to support your salary determination. For an extra layer of protection, consider obtaining a third-party, reasonable compensation report from a qualified professional. Formally approve your salary in your corporate minutes, documenting the rationale behind your decision. Be sure to specifically reference the salary research and data you relied upon when making your decision. The ultimate goal isn't to pay yourself the absolute most or the absolute least amount possible. It's to pay a defensible, market-based wage that you can justify to the IRS if questioned. Pay yourself through regular payroll, ensuring that you're properly withholding and remitting all required taxes, and consider taking distributions less frequently than your salary payments. This helps to reinforce the idea that your salary is your primary form of compensation. If you're paying yourself a tiny salary and then taking large regular distributions every month, the IRS will likely see through this strategy and question the reasonableness of your salary. By diligently following the rules, maintaining thorough documentation, and acting in good faith, you'll be able to enjoy the benefits of your S Corp structure without significantly increasing your risk of an audit. The third big mistake, and this one is a real doozy, mixing personal and business finances. It's a common pitfall, especially for new business owners, but it can lead to serious headaches down the road. We're talking about blurring the lines between your personal piggy bank and your business's financial well-being. This is called commingling, and it's a huge audit risk. The IRS frowns upon it, and for good reason. When your business and personal finances are intertwined, it becomes incredibly difficult to determine what's a legitimate business expense and what's simply a personal indulgence. This lack of clarity raises red flags and makes you a prime target for scrutiny. Your S Corp is a separate legal entity. Think of it as a distinct individual in the eyes of the law. It has its own rights, responsibilities, and most importantly, its own finances. It's not just an extension of you, it's a completely separate entity. Treating its money like your own can destroy your legal protections and invite IRS scrutiny. The corporate structure provides a liability shield, protecting your personal assets from business debts and lawsuits. But, if you treat the business as your personal slush fund, you risk piercing that corporate veil, leaving your personal assets vulnerable. If you pay personal bills from the business account, the IRS can't tell what's a real business expense and what's not. Imagine trying to decipher a tangled mess of transactions. It becomes nearly impossible to distinguish between legitimate business operations and personal spending. This creates confusion and raises suspicion, making you look like you're trying to hide something even if you're not. That's a fast track to an audit. And trust me, you don't want to go there. Audits are time-consuming, stressful, and can be incredibly costly. The IRS will meticulously examine your financial records, and any discrepancies or inconsistencies will be magnified under their intense scrutiny. The fix is simple. Open a dedicated business checking account. This is your first line of defense against commingling. It's a clear separation between your personal and business finances, making it easier to track income and expenses. Deposit all business income there. Every dollar your business earns should go directly into this account. This creates a clear audit trail and ensures that all revenue is properly accounted for, and pay all business expenses from it. Rent, utilities, supplies, marketing costs, everything related to your business should be paid from this dedicated account. This keeps your business finances organized and transparent. Get a business debit and credit card. These are invaluable tools for managing your business expenses. They provide a convenient way to make purchases and track spending, and they also offer valuable rewards and benefits. Use them only for business. Resist the temptation to use your business card for personal purchases, no matter how small. This is a slippery slope that can quickly lead to commingling. To pay yourself, use payroll for your salary. Don't just transfer money from the business account to your personal account whenever you feel like it. Set up a formal payroll system to ensure that you're paying yourself a consistent salary and properly withholding taxes. For extra profits, transfer distributions from the business account to your personal account. This is how you take money out of the business beyond your regular salary. But it's crucial to do it correctly, and label them clearly. Owner's draw. Shareholder distribution. Use specific and descriptive labels so that anyone reviewing your records can easily understand the purpose of the transfer. Never pay personal bills directly from the business account, even if you plan to fix it later. That fix-it-later mentality is a recipe for disaster. It's easy to forget or procrastinate, and before you know it, you've created a tangled web of transactions that's difficult to unravel. Always transfer money to your personal account first. This creates a clear and documented separation between your business and personal finances. It's a simple step that can save you a lot of headaches in the long run. If you use your personal card for a business expense, sometimes it's unavoidable. You might be out of the office and need to make a quick purchase. Submit an expense report and reimburse yourself formally. Treat it like any other business expense. Document the purchase, attach the receipt, and submit it for reimbursement. Keep receipts. This is non-negotiable. Receipts are your proof of purchase and are essential for supporting your business expenses. And use accounting software like QuickBooks or Xero to track everything. These tools can automate many of the tedious tasks associated with bookkeeping, making it easier to stay organized and compliant. This isn't just about taxes, although that's a significant part of it. It's about the overall health and well-being of your business. It's about protecting your assets. Your business is an investment, and you want to safeguard it from potential risks. If you get sued and your records are messy, it can be difficult to defend yourself and your business. You could lose your personal liability shield. Commingling can give plaintiffs ammunition to argue that your business is not truly separate from you, putting your personal assets at risk in a lawsuit. Respect the corporate entity. Treat it as a separate individual with its own financial identity. Separate accounts Keep your business and personal finances strictly separate. Clean records. Maintain accurate and organized financial records and formal processes. Establish clear and consistent procedures for managing your business finances. It's a little extra work, but it protects you from audits and lawsuits. And in the long run, it will give you peace of mind knowing that your business and personal assets are secure. There you have it. The top 3 S Corp audit triggers: worker misclassification, a common area of scrutiny; unreasonable salary, which can raise red flags; and commingling funds, a clear sign of trouble. Avoid these common pitfalls and you'll run a smarter, safer business. The S Corp is powerful, but only if you diligently follow the rules. If you found this helpful and informative, like and subscribe for more business tips. Drop your questions or share your experiences in the comments section below. And remember, always consult a qualified CPA or a seasoned tax attorney for advice specifically tailored to your unique situation.